Up, maybe. Perfect. Thank you. There's still some people logging in the lobby, but I'm going to go ahead and get started, at least introduce myself. I work at GBS, the retired division, so we consult on a lot of 401k plans and group benefits. But in addition to that, we have a private wealth side of our business, and that's the group I work in. Um, my work history surrounds demographics, economics, capital markets, so that type of thing. And I tend to be more of a glass half full than half empty, judging by the information that I have that I'm going to share with you today, at least a portion of it. So I hope everyone gets something from it. At the end, there's going to be a slide on how to contact us, and I would encourage you to do so if you have any additional questions. So let's go ahead and get started. Some of the topics we will cover: market forecasts versus reality. So what you see in the news versus what actually happens. The role of people in economies and how important that is. And then I'm going to go over tariffs, inflation, stagflation, and recessions. Basically all of the buzzwords we all hear these days in the news and from friends and family. And talk a little bit about how that has impacted economies in the past, how it's impacting us today, and maybe what to look for going forward. All right. So that being said, I know that the beginning of this year, things have been all over the place, so to speak. I like to equate it to being on the Tower of Terror. You're good one moment, and then the ride falls down, and I don't know. The ride terrifies me personally. I've never been a big guy of that, big fan of rides like that. But that's kind of how a lot of people feel today. The market is all over the place. The news is all over the place. It's constantly changing by the hour, and it seems as though none of it skews positively. So no doubt about it, if any of you have looked at your investment accounts, you have seen them go up and down pretty dramatically compared to the past. And I want to tell you a little bit about why you shouldn't be too concerned about that. First of all, this is a chart that illustrates returns of the S&P 500 over each year. And you'll see the intra-year declines are there in red. So even though a lot of the times you experience double-digit declines in the overall market, it ends up positive a majority of the time by the end of the year. So the closest one that I want to share is 2020. You'll see that the market was down as much as 34%. I think we all remember the very beginning of 2020. It was a rough time. No one knew what to expect. But shortly thereafter, the market started to recover. It didn't take very long. It literally recovered in like 2.5, 3 months. And then it ended the year in positive territory, about 16%. So you are going to experience declines like this. A lot of that has to do with people's emotions and the market being efficient and making choices before outcomes could potentially happen. But for most of us investors, it's best to just know that this happens and stay the course versus panicking when you see your account balance go down. I know that's hard to do because we all work exceptionally hard for our money. So we don't like to see that happen. It can be painful. But please try not to make any emotional decisions around that, because I've seen it dozens and dozens of times where it severely impacts people's retirement if they make those decisions. All right, market forecasts. I do not have a high opinion of market forecasters. It's essentially they're good guessers, and not even that, they're not even good guessers. It makes no sense to me why they put these out. You'll see last year, this is what some of the quote unquote pros or professionals were expecting of the S&P 500 to return for that year. JP Morgan at the very bottom, way off. They were expecting down like 11%, and it ended up 23.3%. So you can't predict what's going to happen. You can't predict innovation that came in the middle of the year around artificial intelligence. I mean, the market forecasters, it shouldn't be a job that exists, in my opinion. You can share ideas of where you think the economy is, but if someone out there is giving you a market forecast, or you're reading a news article that says, JP Morgan says the stock market is the S&P 500 is go down 9%. It doesn't mean anything, because they don't know any more than you and I. And even if they do, they're guessing. They have no idea how people are going to behave. So I hate people that make market forecasts. They've been studied in the past, and they've been consistently wrong on almost everything. So very few people have I met that have even gotten it right on a 1-year basis. Okay, I'm sorry, these charts are kind of all over the place, but I promise I'll make sense of it pretty quick. On the left there, you'll see the average cumulative S&P 500 return from 1988 to December 31st, 2024. Gray is when you're investing on any day. So think of that as, your 401k, money comes out of your paycheck, it goes in whatever day it goes in. And then you invest at a new high in green. You would assume that since you're buying it at the very high, that your future return is going to be low or lower, and it's just not the case. If you take a look at those numbers there on the left, a lot of the times it's actually one of the best times to buy. We had a significant number of new highs last year. So if you were to sell because you hit 2 new highs, you would have missed out on 22 additional, new highs. So downturns and upturns, on the right-hand chart there, you'll see that that's the performance of $10,000 invested when a recession began. So in green, you'll see that a majority of times, even if you're in the middle of a recession or about to enter a recession, the return is about 8.8%, the average after 2 years after a recession began. So again, this just goes to stay invested versus trying to time investing. And that's what I'm getting at here. This is the performance based on time in the market. So 1990 to 2023, 27,221 days, $21. If you missed one of the best days, it goes down to 24,000. And then if you miss the 25 best days, it goes down to 5,000. So that's why you got to stay invested. You never know what day is going to be one of the best days to be invested. And if you miss it, it makes a huge impact on your return. This is just an allocation performance over time. So green is largest annual return. Those are going to be stocks. Blue, smallest, and orange is average annual return. So if you look at the left, you can have a swing in any given period, up or down pretty dramatically. And then when you start to reduce risk in your overall portfolio by adding bonds or other short-term guaranteed certificates like that, it reduces your overall swings, so to speak, but it can and does reduce your return historically. So it's all about how long you stay in the market. It's also about how you're allocated. If you're allocated 100% bonds, if you're saving a ton of money, maybe you'll make it to retirement. But if you are saving an average amount, you will never be able to retire if you're invested 100% in bonds or cash. All right, this is my favorite part. People. People are the most important part and the important thing for all of us to look at. So we all read news that talks about the economy and geopolitical risks. I mean, you name it. Like, I have not in 20 years opened up a newspaper that says everyone has enough water and everyone is happy and there is no trade wars and there is no wars. I mean, it's never happened. You open it up and it's always the worst news in the world and that we're all going to die. And if you believed it, you'd be terrified. But if you ignore all of that and just look at the number of people, that's the most important, because economies are made up of people and people are easy to predict. So these are, there you see 3 generations: boomers 77 and millennials 92 million. Take a look at this chart here. See those orange boxes, orange squares are what we call a lost decade or a flat stock market. So 1930 to 1950, the market didn't do anything. 1970 to 1960 to 1980, market didn't do much. And then you'll see here, obviously 2000, 2010. I think most of us remember that one. But in between there, you'll see big upswings that last for decades, and those are called secular bull markets. So yeah, there are declines in those during those time frames, but they generally go up and to the right for about 20 years. The reason for that is kids. If you have babies, you have forced spending. So it doesn't matter what's happening in the market. If your kids need shoes, you're going to buy shoes, medicine, doctor's visits, school supplies. I mean, you name it. Any of us that have kids know that it doesn't matter what inflation is. It doesn't matter what tariffs are. I mean, we have to provide for our kids, and we're going to do it. So if you look, when the baby boomers are being born from 1950, 1970, secular bull market, 70 to 80, they weren't doing anything, protesting the war and living in communes and I don't know, all that crazy stuff, wearing some pretty fancy clothes. 1980, the boomers kind of grew up and they started to have kids and buy houses, and they had the millennial generation. We saw a secular bull market in the United States till 2000. 2010 was going to be a flat decade regardless of what we did. There's just not enough people in Gen X to make up for the boomers, the 77 million boomers, and the amount of kids that they had. So we already had everything. We had the schools, we had the doctor's offices. We didn't need to build more stuff. Unless they decided to double or triple family size, it was not going to impact the US economy. So what did we do? We forced growth by giving mortgages to anybody that was alive, or maybe in some cases not alive. And then we had a collapse, as we all know. And then the millennials were coming of age shortly after that. So they really didn't start to do things until, and I say do things like grow up, buy houses, have kids, get married, until around 26. And they do most of those things between 26 and 28. So if you take a look, I believe we started another secular bull market based on ages around 2012 or 2014, and it should go for another 20 years. I put a different chart on there because this illustrates that a lot of stuff takes place in the world, and our stock market here in the United States and in general does very well. It doesn't matter what's happening. If people are on the earth and buying things, that's what makes up an economy, not Cold War, end of the Cold War, Vietnam War, or Korean War, post-war boom. None of this really impacts the economy to a massive degree. If there's enough people, people are going to buy stuff. People are going to provide for their kids, buy housing, fill that house full of stuff from Costco, and it propels the economy forward. So that is what's happened throughout history, and demographics are some of the most important. So why has everybody left millennials for dead, thinking they weren't going to do anything? Well, I like to use the example of TV shows. So popular TV shows about 20 to 30-year-olds living in apartments, not getting married, not having kids. I think all of us know most of these: Seinfeld, Friends, How I Met Your Mother, The Big Bang Theory. The reason that these stop after 10 seasons is that no one wants to watch a 30-year-old Chandler Bing move to the suburbs with Monica. I mean, the show is over at that point. They're going to lose their audience, so they wrap it up, and then they come out with another one, and it's basically the same thing. How I Met Your Mother, The Big Bang Theory. I mean, there's not much difference between the two. So everyone assumes that millennials aren't going to grow up. They assume they're not going to get married. They assume that thgoing to have kids, that they're not going to buy houses. And I've been saying it for a long time, and I'll say it again. It's already started to happen. It was going to happen. It was a certainty. Even if they said they weren't going to do it, they absolutely were going to do it. They just didn't know it. Because you grow up it's fun to be the cool millennial that doesn't have a care in the world and lives with their friends for 400 bucks a month as a roommate. But eventually you get to an age where you're like, I don't want to do this anymore. Like you find someone you want to marry, maybe you just want to move out. But there's a lot of misperceptions around millennials, and really any generation. They always get hit with a bad rap. The boomers, they said the same thing about the boomers. Will they ever be as well off as their parents? And obviously, we see that they were more than well off, better off than their parents. So these on the screen here, I saw this article 2 days ago in the Wall Street Journal. Home buyers start to come off sidelines even as rates and prices stay high. And underneath that is what uh, was surprising: a new baby, a new job, and other big events spur some to quit waiting. You can't pause your life for what rates are going to do. That is the best example of what I've been trying to say. It doesn't matter what's happening. You're going to hit certain life milestones and time goes on. You don't dwell on the past. If you have kids and you need a house and you want to buy a house, you buy a house. It's just the way that people work. That we're biologically wired that way. So it's all very predictable. None of it is surprising to me. The other thing people say, millennials don't want to have kids. That is so frustrating to me because they have the highest birth rate of any generation in history from the ages of like 28 to 43. So, and if you look here on the right in the oval there, you'll see that teenage pregnancies from 1990 and really early 20s they've collapsed. So when you read about the birth rate that gets printed in the news, they never talk about that. So they just print it as birth rates down. Okay, well, the birth rate's down because teenagers aren't having children. That's not a bad thing. And I wish they would, put an asterisk next to it at the very minimum. Because look at the positive side of it. 30 to 34-year-olds up 22%, 35-39 up 67%. These are really, really good times to have kids, economically speaking, because you have way more money at that age to spend. I mean, I fall into that group. I started having kids in my late 20s, and I'm in that cohort. And I can tell you right now, I almost wish I would have had kids when I was 20 because I would have far less money and I would be buying way less tutus and dance classes and unicorn stuffed animals. So, anyways, on the left, marriages. This is the other thing that's frustrating. Millennials don't want to get married. Okay, again, not true. Take a look at 2010 to 2022. These are all millennials during that time frame for the most part. They're like prime marriage age. So I shouldn't say it's all millennials. There's other people mixed in here, but if you start to take a look at the marriages taking place in the United States or household formation, it really started to take off around 2016. It went down around 2019, and then 2020 we obviously saw a big drop. That I'm surprised we had 1.7 million marriages in 2020. Don't ask me how that happened, but it did. And then you start to see a big spike after that because millennials are getting married contrary to what people think, and because they're getting married later in life, they actually have some of the lowest divorce rates right now. All right, on to the fun section that I know most of you may have joined for. Tariffs, inflation, and stagflation. Uh, I'm not a political guy. I'm not going to get into politics. I'm going to speak mostly about how these things are going to potentially impact us. Because quite frankly, none of us on this call really have control over any of these things. So it's more or less preparing ourselves for what the future might look like. And I like to compare it, or I should say, people compare it to the 1970s. We're going to be in the 1970s. I hear that almost every week. Well, it's very different. 1970s had 14% inflation, energy prices, oil embargoes by OPEC. We had lines at gas stations, or you could only get gas if your license plate ended in a certain number on a certain day. It was an interesting time. GDP was weak. We had multiple recessions. The Fed at that time raised rates like aggressively, the most aggressive that we've seen in history in order to fight inflation, and we had structurally high unemployment. Let's take a look at today. Inflation elevated, but not dramatically so. We're slightly above the 2% targets, so like 3.5. We have more oil than the United States needs. We're actually the #1 oil producing country in the world. We actually export a huge majority of our oil and natural gas. We do not need, and we are not dependent on any other country in the world for energy. We have more than we ever could use, and we have proven reserves that are off the charts. So even with elevated rates, this is what I want to talk about as well. We've raised interest rates from 0 to 5.5%, and the economy hasn't skipped a beat. I mean, think about that for a second. We raised rates to slow down growth, and it's still growing. People expected a recession. It didn't happen. People expected it to hit the job market. It didn't happen. Why? Because millennials are starting their life off. It doesn't matter if mortgages are 6.25%. It doesn't matter if inflation is 3 or 4%. That's why the economy keeps propelling forward, and that's why people are the most important. So today, historically low unemployment and strong job growth taking place in the United States. And a lot of this reminds me of a particular part of cars. So I'm going to play a short clip here that reminds me of it. Again, I don't know why I think that is. It does make me laugh. Like, we are not the same. All right, now get out of here. That's what I want to tell people when they start talking about the 1970s. It's not the same. It's not the same market. It's not the same economy. And by the way, in the 1970s, there wasn't the baby boomers were not old enough to be hitting those milestones. And I think if they were, the 1970s wouldn't have been as bad. So it was just they were too young. The boomers were too young. A lot of them were still in high school. So the 1970s didn't have the cohort that we do today. All right, inflation. It sucks. I get it. You know what's worse is deflation, but we're not going to talk about that today because it's not happening here. Take a look at inflation. Those are the red dots there. Inflation does not mean that the economy is going to take a massive hit. It does not mean that stocks or your investment portfolio is going to take a massive hit. In fact, it's the only way to protect against inflation is by investing. So you'll see there in green, those are the annualized returns from the 1990s, 2022, with inflation dots there. So 2022 wasn't really related to inflation. It was more some of the tech stocks that were overvalued. But it's not something to be concerned about. It would be concerning if it was into the double digits, but as a developed economy and the way that our economy works, that's just not likely to happen. So, all right, the other thing I want to talk about, it's different than the 1970s, is we are onshoring a lot of manufacturing for various reasons, not just for, this is a trend that started to take place before Trump was in office. I don't want him to take credit for this. Really, any politician shouldn't be taking credit for this. But you'll see in red there, that's the manufacturing construction index that has just taken off like a rocket since 2020. The reason for that is we are now one of the lowest cost countries to produce goods in. Believe it or not, that is a true statement. We are one of the lowest countries in terms of transportation costs. We have rivers that run through our country that you can transport goods on, trucks. We have ports on all sides of our country. And on top of that, we have a very, very educated population that can manufacture things that other countries can't. So yes, low value add products, pens, they might be made in Vietnam, but no one's going to open transmission and engine factories and that type of thing in Vietnam. They're going to open it here in the United States, and that's why you see this massive spike in red. That trend is likely to continue for a very long time, particularly with Trump's tariffs that are coming into play. it's going to impact. It was already happened before. It's going to happen even more now. A big portion of that too is energy. A lot of the companies that are already onshoring here in the United States are energy related. If you're in Europe and you depend on any form of energy for your business, you almost went out of business over the last several years. You go to the place that has the most reliable source and the best economy with legal protections, and that's the United States. Here's a quick chart on oil production. I'm not going to spend too much time here. I've already talked about it, but you'll see on the left oil production by barrels. And obviously we hit a bottom there in like 2008, 2009. There's a gentleman in the Woodlands, Texas, that came up with shale drilling in order to try to save his company because he had a contract to supply Chicago with natural gas and he was running out of it. So he was gambling and kept telling his engineers to drill, 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 and he figured it out. And you can see what happened after the fact. So we have more proven reserves and substantial oil production in the United States. All right, trade. We hear a lot about trade, especially today. Trump is targeting everything, and other countries are starting to target other parts of our economy. It is concerning because no one wins in a situation like that. I hope that there's more of a long-term plan in place that, maybe we're doing these things to get better trade terms, or where our country in general may have been taken advantage of and then they're going to be scaled back. Regardless, I'm just going to assume they're going to stay there forever for this conversation. The United States is an exporter of manufactured goods, absolutely. But more importantly, and one of the largest parts of our economy is services. So we export a ton of banking and finance and capital, music, entertainment, legal advice. I mean, you name it. Engineering is a huge one. We export a significant amount of services to other countries, and it is a massive part of our economy. So that is not being targeted with tariffs. So, there's you hear in the news that it's, whatever cars or something, but the engineers that make the cars that sell those engineering designs to BMW and Volkswagen, it still counts in our economy, and there's no tariffs on that. So yes, tariffs, not fun, but you got to think of the other side of it as well. Like, not all of us are in factories making things. A lot of us are at desks doing engineering and jobs like that. So here we go. This kind of made me laugh. Biggest worry everyone has is tariffs. It's not a win situation for anybody. I would say prepare for inflation. It's going to be something that, if they go through, no doubt about it, it's going to raise the inflation rate. Fortunately, our economy is very strong, even with rates at 5.5%. So it doesn't concern me. If it was 5 to 10 years from now, and most of the millennials have had their kids and bought their houses, then yes, this would be a very, very big concern of mine, because there's going to be fewer of the people we need spending all their money to keep the economy going. So today, is it a concern? Yes. Am I panicked about it? No. It's something I would prefer not to have, but it will increase the inflation number like we see here. But as you can see, let's say that, it really starts to impact things. Look at the 90s. The 90s is a pretty decent example. Early 2000s, pretty decent example of inflation and market performance. So it doesn't mean that the United States' economy is going to suffer. In fact, people will just shuffle supply chains, and it could actually benefit the United States in some ways. So I will say that other countries have a lot more to lose than the United States. The United States imports a lot of stuff, and most of those countries are reliant on exports. That's their entire economy. You throw tariffs on them, and it cripples their economy, because we're the largest consumer market in the world, and we import a significant amount of everything. So tariffs on those countries, they are going to cave so fast because their economy is going to drop like a stone because they have to find another country to sell those goods to. And quite frankly, who's going to buy them? Like, who's going to replace the United States, the largest economy in the world? Kenya? I doubt it. All right, in summary, market predictions. Everyone loves a good guess with a 5% chance of being right. The real currency to focus on is humans. Without us, the economy would be just a collection of numbers on paper, and that's pretty boring, which is also why I stopped studying economics as much as I did and started studying demographics of people. The past isn't the present, although I'm getting older, because if you look at the fashion choices of younger generations, it makes me realize that I am no longer young, so it's painful. I would not be concerned about anything going forward as of right now. I will say, take a look and be aware of things that are taking place around you, and in the way of people. Do you have any nieces and nephews, or yourself, or friends that are getting married? What ages are they getting married? Are people having kids? How many kids do you see in a restaurant or a grocery store when you're out and about? Those are the things that I look for. And then obviously I research and interpret a lot of data that's provided to me. But you can still get an example of looking at people, looking at kids. That's what fuels economies, is people. If people don't exist, there's less money, there's less productivity, there's less labor, everything in the economy. So people are the most important driver of economic growth and stability in any economy. And I'll give one example of that, and then I'll wrap up. Italy. Italy has been losing native-born Italians for decades. I mean, to an extreme degree. You wonder why you see in the news why homes are free in Italy. They have no people. Like, if you don't have any people, there's no demand for housing. Housing prices don't go up if you don't have people. If your people are declining and you have X number of homes, then you either tear them down or you start giving them away for free to get people to move to your country. So that is an example of what happens when you don't have people or are on the decline. Okay, I'm going to wrap up here. You can schedule a meeting with me by scanning that QR code. In addition to that, you can email me. I'm going to go to the very front there. It'll have an email address and phone number. Scan that QR code, and I'm happy to meet with you in person or virtually. And then if I get back to slide number 1, it will have my contact information on there as well. Feel free to email me, call me, any questions, comments, concerns. Obviously, we are investment managers as well. So if you're interested in anything like that, let us know. But I hope you all gained something from the presentation today. I would say focus on people and stay the course, because that's the most important thing you can do. Thank you all. I appreciate it.